Hey guys, welcome to the investment and property market update for September, where I'll be updating what's going on in investment markets, what makes smart money choices, and the key things that you should be thinking about to make the most out of your money with where the world is at right now. And look, there's a lot of interesting stuff that is happening at the moment. Um, we're obviously seeing rising inflation, interest rates, the impact on the property market, the impact on the share market, and all that sort of stuff, which I'm keen to dive into. Just before I do, though, you can check out our other content if this sort of stuff strikes a chord, or hit us up if you want to chat one-on-one. And also, team, please don't rush out and make any life-changing decisions off the back of what we cover. I strongly suggest you seek out personalized advice before jumping in. Jumping into what's going on in markets with investments and property. The first thing that's what's driving markets, we're seeing the Australian interest rates slowing down. The RBA put interest rates up by 0.25% again yesterday. That is the fifth consecutive interest rate rise in a row, total increase of 2.5%. But the good news is, and it's funny that when that happened, the share market just started going ballistic. And then that seemed to, normally the market swings go the other way, but it seems to have filtered through to the US market, which has had a big day overnight. Last night, the Australian market up strongly again today because the interest rate rise, while it was a rise, and rises never seem like a good thing, the fact that the RBA has gone back to a more normal increase of 0.25% instead of the 0.5% rises that we've been seeing over the last little while is a little bit of welcome news, and suggests that we could be seeing the end of things. In fact, I was just looking at something, a piece today talking about the fact that the property market could be sort of back moving forward again by early in 2023. The share markets are rallying. That's partly off the back of that inflation news, particularly in the last couple of days, and as well as the strong underlying data that's like what's going on in the economy in Australia with spending. People are still spending money, companies are still making money, unemployment is still really low. So there's a lot of investment opportunities that come off the back of that as well. And the good news comes with some bad, though, and we are still seeing that global economies are struggling around the world, particularly the US and the UK. The UK is in all sorts of pain at the moment, with like 13% inflation expected there, and tax cuts by the government that doesn't really have the money to pay for it, and still facing a lot of disruption. In the US as well, we're seeing a bit more of a slowdown, and I'll get into some of those numbers around that. But that is an issue when those bigger markets start to slow down or face trouble, because that filters through to Australia, to the Australian market, and to Australian investors in particular, and companies too. The property market is softening, and I'm going to dive into the numbers on that, but there's no doubt that it's softening around the country. I think all major city markets are now in decline. Started led by the Sydney and Victoria market, but it's filtering through to the other areas, Queensland, Adelaide, Hobart, Perth, that had previously been continuing to tick up, even though the Sydney market was softening. So they're talking about, and have been talking about for the last little bit, the property market, we're seeing the worst selling conditions in years. But on the flip side of that, what that means is that it's the best buying conditions that we've been seeing in years, and particularly because they're talking about the softening of the property market in Australia slowing down or turning around sooner, and perhaps as early as next year. It's sort of like you want to take advantage of the opportunity while the opportunity exists, if it's something that makes sense for you. Growth is still going pretty strong in Australia. We're still seeing strong economic growth, really low unemployment, and companies aren't slowing down on hiring, and that's good for investment markets and for jobs and for people in the economy, but it's good for investors as well. The actual market numbers. So, firstly, in the property market, we've seen Sydney in the last month has declined by 1.1%. That brings the year-to-date decline to 7.8% in the Sydney market. Melbourne down 0.6%. That brings their total decline to 4.9%. Queensland is down 1%. So they've just started going into that negative territory, and they've just tipped over to the year-to-date growth in Queensland is now down 5.4%. Adelaide is down just a really small amount at 0.1%. Their growth, though, for the year is still up by 11.4%. So the market performing really strongly there. The small rates have declined because they've just started. They haven't filtered through. The property prices are still up. Perth is down 0.2%. That brings them to a 3.9% growth for the current year to date. And across the 5 capital cities, we're seeing 0.8% decline in the last month, down a total of 3.3% for the year. Looking at the share markets and what's going on there in the last month in Australia, so the ASX 200, that's the 200 largest companies in Australia. That's down 4% for the last month, and bringing the total year-to-date performance of the ASX 200 to negative 10.4%. That might sound bad, but it's not as bad as what's going on in the US, where we're seeing the S&P 500. That's the 500 largest companies in the US. They're down 4% for the month, but almost 21% for the year. The NASDAQ, the tech-heavy index, the biggest technology companies in America, that's down 10% for the month and now 30% for the year. And the crypto index is pretty flat over the last month, but still down 59.43% for the year to date. So some movements there. Market's still on the down, but overall, again, like you see good companies that were good companies 6 months ago are now good companies on sale for 20% less. Our investment story of the month, and normally I dive deep into a company here that's performing, but this move was so big that I thought it was worth unpacking here. We've seen the Queensland government scrap these changes to their land tax that they were talking about. If you haven't heard of this, that essentially what they were going to do is that anyone that owned property in Queensland and other states as well, they were going to add up the combined value of all of the property and then tax you as if you held all of that property in Queensland, which would have been a real problem, because if you own one investment property in Queensland, one investment property in New South Wales, one investment property in Victoria, you previously wouldn't have paid any land tax. But with the new rules, you could potentially be paying thousands of dollars a year. I think the figure from their website was like $8,000 a year, which is a pretty steep price to pay on top of, the increased cost of borrowing and just a general operating cost from a property as well. So that has a huge impact for property investors, both from an admin and a cost perspective. But there was a big meeting in National Cabinet last week. The premiers are not happy. Dominic Perrottet, the New South Wales Premier in particular, noted that he wouldn't be sharing data on New South Wales residents, and the other premiers all said that they weren't happy. So thankfully, the Palaszczuk government has decided to scrap these amendments to the tax, and essentially Queensland is back open for business when it comes to property investments. Now, this proposed land tax did have a pretty big impact on new property sales in Queensland, which we saw pretty much seize up over the last little bit. But now that it's been scrapped, my guess is that there's going to be a lot more activity, particularly Brisbane, Gold Coast market, as well as Sydney and Victoria. They're the markets in Australia that have the strongest population growth expected. But given the price points of the Sydney and Victorian markets, it means that Brisbane makes a lot of sense from a property investor point of view if the strategy stacks up. So it's good for a lot of people, I think, to know that they're back open for business, and it also makes sense to consider Queensland as a property investment space as well. Market watch and things to look out for with the markets over the next coming months, I suppose, into the lead up to the end of the year. The inflation data in Australia is going to be really critical for what happens in the share market. We're seeing that start to turn around, but how quickly it turns around and how far it turns around are really going to be big drivers of what happens with interest rates. And that's going to be a big driver of what happens with the economy. We're also seeing a lot of property buyers on standby. It's funny that when there's any sort of disruption to markets, a lot of people start freaking out. They don't want to do anything because understandably don't want to do the wrong thing, but just end up doing nothing. And if that trend continues, then the prices will soften further, but it's likely that they will then recover incredibly quickly because a whole bunch of people will rush in as soon as the prices start recovering. People get this FOMO and they want to jump back in and end up paying a slightly higher price, but it really accelerates how quickly the market recovers. The other big thing is what happens in the US, like being the biggest investment market in the world, that does have a flow through impact to the Australian market. And also looking at what happens with the share market. We've seen a rally, but how far that continues and how quick it goes is another thing to look out for over the next little while. Looking at what's going on in the actual economy itself in Australia, so we're still seeing our inflation up at 6.1%, so holding pretty steady. We're just waiting for the latest data to come in on that. One good measure that we've got, though, is that our household savings rate is currently sitting at 11.4%, which is quite high. Having a high rate of household savings is good because it means that even when interest rates are going up, it means that households can continue to spend money because they've got a bit of a pool of funds to draw on. This is quite different to what we're seeing in the US, where their savings is really low. And I think that's why the economic impact is impacting them more, impacting their share market more as well. We're still seeing the economy growing. So Australian economic growth is at 3.6%, and that's up from 3.3%. So it means that the growth of the economy is actually still increasing, even though we're seeing these interest rates ratcheting up and all of these things happening. So our economy is actually still in a really good spot. And that's a funny thing when you look at investment markets having come off 10% or so in Australia and bigger for companies with exposure to international markets. Like, these companies are making more money today than what they were 6 months ago, but the prices are now discounted. So something to keep in mind. Unemployment is still going down, so down 3.4%. That's from 3.5% previously, so getting to historical lows there. And that's while the employment growth, the number of jobs out there and the people in employment is still growing at 3%. That growth is slowing down, but that's sort of partly natural as we're getting to full employment, because there's only so many people that can take these job vacancies. The job vacancy rate is really high at the moment. People can't find the right people to fill the jobs. China's growth is really slow, and that's an issue, although they've got these crazy sort of COVID lockdowns and stuff continuing to happen over there, which seems a little insane to me. But because they're sort of just chugging along with it with really low levels of growth, my guess is that typically they'll want to bounce out of that, and they'll probably do it by big spending. That benefits Australia because they typically buy up our resources, iron ore and coal and stuff, and that keeps things moving forward pretty quickly. The Aussie dollar, though, is completely in the tank, down at 65 US cents. That's down from 69 cents just last month, which is like a massive decline. It might only seem like 4 cents, but that's like a 5% off on the currency, getting to historical lows for the Aussie dollar. That creates a bit of an opportunity for investors where you can benefit from companies that will benefit when the Aussie dollar recovers. So you think companies that have exposure to the export markets. Also, there's a number of investments that have like Aussie dollar currency pegs with the US building, so that when the Aussie dollar goes up, these investments go up as well. Personally, I think there's a fair bit of opportunity in that space at the moment myself. Looking at the US as the biggest investment market around the world, that their inflation is slowing down, so 6.3% down from 6.8% the previous month, but their core inflation, so the underlying measure of inflation, is still on the up, which is a concern. And that's why their share market is suffering so much at the moment. Their economic growth at 1% is much lower than what we're seeing in Australia. And that's what I meant when I said that they've got a bit more of a slowdown happening there. And also we're seeing their unemployment rate is increasing in the US. So it's up 0.2%, so to 3.7% from 3.5% last month. The household savings rate is half of what we're seeing in Australia at 5.2%, and lower than the levels that we saw pre-COVID. And new properties being built, this house starts, as they call it, is down 10% over the last little bit. Getting into some of the trends from investors that we're seeing property buyers standing by and sitting on the sidelines while they're servicing declines. Now, what a lot of people don't realize in the property market at the moment is that when interest rates go up and property values are going down, people think to themselves that they can pick up a bargain in the property market by waiting a little while, because the property that they want to buy today is going to be cheaper in a month from now or 3 months from now. But what they don't realize at the same time is that at every time interest rates increase, the amount that you can borrow from the bank actually reduces, because they're stress testing with their service rates or whatever. And that means that you can actually borrow less. So if your property price goes down by $20,000, but your borrowing capacity goes down by $100,000, it can mean that you're actually no longer able to buy the property that you want. So understanding with that one, like understanding that what your borrowing capacity is, I think is something that's really important at the moment, to make sure that you're prepared. If you understand, if you know you've got a super strong borrowing capacity and you look at it and you say, well, I can do it anytime and the serviceability doesn't really matter, then that's fine. But if you're sort of like at that tipping point where it does actually matter what your servicing looks like, then you want to really know what your moves are and when you should pull the trigger, so that you can actually get the right results and be able to buy the property that you want at the time that you want. Share market investing is back in focus with the and it's weird that normally as soon as the share market starts recovering, people want to pile back in after they've missed out on sort of the bottom as well. But shares are firmly back in people's sights at the moment, with the interest rate seeming to slow down and the recovery off the back of that. We're also seeing a big trend from investors is that fixed interest rates are expiring. There are a lot of people that locked in fixed mortgage interest rates while rates were incredibly low. A lot of those rates are starting to expire, and a lot of them will continue to expire over the next 12 months. And that is resulting in a big step up in mortgage repayments and having an impact on people's abilities to invest and sort of have the money that they previously had left over for their lifestyle spending. So there's an opportunity there. There's an issue there that you need to make sure that you're aware of, though, when it comes to your other investing as well. Getting into the hacks and mistakes over the last month, that firstly, our client story of the month. This is a couple we've been working with recently in their 30s. Their income was $210,000. Their total assets and investments was 1.1 mil. They were saving $15,000 annually. When they came to us, they were struggling with information overload, like all the options out there, too many options, too much information. They were also time poor, which probably wasn't helping the situation, in that they were struggling to find the time to make this work and also do the research they needed. And they had, as a result, they weren't able to plan properly and had no clarity on where they were actually going financially, how they were tracking towards their goals and the position that they wanted to get into. What they wanted to do was grow their assets with their risk managed. They wanted to build wealth, and they figured that they probably needed to borrow and buy property, but they wanted to do it in a way that they felt comfortable that their risk was managed. What we did with them is we set up a clear savings system to make it easier for them to save and manage their money, save some of that time that they really didn't have to be shuffling money around from one place to the other, buying an investment property and setting up an ethical investing plan for compounding and regular interest over time. The ultimate benefit, they sort of leveled up their money game, but the quantifiable benefits from implementing those strategies was $56,000 in year one. And after year 20, just some of those small tweaks meant that they were going to be $2.1 million better off. To me, this shows the power of just having that clarity, but also having someone to hold your hand to let you know when you should be taking risk and when the risk is too much. Our client problem of the month, And there's probably a handful of clients that we could put in this, but one in particular comes to mind that just got worked in technology, had a ton of technology shares. Now, I'm a big believer in technology, but I find that tech people tend to be all in on drinking the Kool-Aid, and that's great when the markets are going up. But what we're seeing with the NASDAQ tech index in the US down 30% this year, and a lot of companies impacted even more than that, it's meant that this client really copped it on their wealth building side. Really stressful, annoying, frustrating, and ultimately making some really difficult decisions. The lesson I think in this one is to make sure that even when markets are going well, that you don't think that that will continue forever, and you're trying to spread your risk out so you've got a lot of eggs in a lot of baskets, meaning that you're not going to be so concentrated when one of them starts performing below average. Our money mistake of the month is a client that we work with that they got stalled on their action based on fear of what was going on in the markets, and looking at some of the headlines and media, knew that they needed to do something, but too scared of doing the wrong thing, and just so ended up doing nothing and sort of sitting on water. Had this money that was just building up. They weren't doing anything with them, weren't putting to work. And looking back, and we just went through the planning process, they made some decisions, pulled the trigger on some stuff, and they were kicking themselves for not having done that sooner than they did, because they would have been in a much stronger position if they did. Our money hack of the month is, and this is an interesting one when the share markets are down, is reshuffling investments. So particularly for people that might have wanted to make changes to their share portfolio or ETF portfolio, but when the markets were up, they were sitting on these big capital gains that have tax bills attached to them. Now that the markets are down, it means that you can make some changes to the things that you're invested in, but do it in a way that's not creating a lot of tax obligations for you to do that. So a lot of opportunity, particularly given that the market is starting to rally at the moment, that for anyone that had thought of maybe making some changes to their investments but didn't want to pay a bunch of tax to do that, now is a good time to be revisiting that and seeing if that's something that you should potentially be looking at. A client success story of the month was purchasing an investment property in a soft property market. Had these clients that picked up a steal really in the Sydney property market, settled on their property just a few weeks ago. Now, if you looked at it on paper, that you might see that the property price had potentially declined a little bit more, although they picked up such a good deal that it probably hasn't. But they had their ducks in a row, and even though the market was going down, they knew that it was the right move for them. They had the confidence that all of their risks were managed, so they pulled the trigger, got a great property, and one that, even if it does go down a little bit more in the short term, is going to add hundreds of thousands of dollars to their wealth position into the future. Guys, that's it for me for this month. I hope you enjoyed that. Plenty of opportunity out there, plenty of risk and fear as well. But yeah, if you enjoyed that, would love you to share it with anyone that you think would value. Guys, I hope you enjoyed that. I'll catch you on the next one. Bye for now.